Hi, I'm Christine Short, Associate Director with S&P Capital IQ Global Markets Intelligence. In this week's Lookout Report, we take a look at how third quarter peak earnings season is faring. With 356 companies having released earnings for the third quarter, the S&P Capital IQ growth rate currently stands at 5.3%, within the 5 to 6% range Global Markets Intelligence had anticipated at the beginning of the season. While this is still lower than the 8% historical average over the last 13 years, this does mark the strongest quarter for earnings growth in 2013. Since the beginning of the season, 9 of the 10 sectors, all with the exception of energy, have seen their growth rates increase. In fact, healthcare, materials, information technology, and financials have all seen their growth rates more than double in that time. Information tech results, in particular, have been surprising, reporting the largest percentage of earnings beats of any sector, with 85% of companies surpassing analyst estimates. Better than expected results from Google, Microsoft, and Apple played a big role in increasing overall profit growth. Despite the improvements in IT, it's still far from being a leader. The leading sectors remain telecommunications and consumer discretionary. For telecom, 3 of the 6 companies within the sector have reported thus far, all 3 growing from the year-ago basis. But only AT&T, Verizon have beat estimates, while Crown Castle International missed by 2 cents. This quarter, the sector no longer includes Metro PCS Communications and Sprint Nextel, 2 companies that had dragged on the sector. The exclusion of these companies makes for an easy third quarter year-over-year comparison, and is the reason for the high growth expectations. The second biggest leader this quarter is once again consumer discretionary. Of the 45 companies that have reported from that sector, 73% have beat analyst estimates, the second most of any sector, behind information technology. Some of the same industries that drove growth for the sector in the first half of 2013 continue to show strength in the third quarter, mainly the textiles, apparel, and luxury goods industry, household durables, and the internet and catalog retail industry. On the flip side, analysts expect only one sector to report negative earnings growth in the third quarter. The biggest decline this quarter is estimated to come from the energy sector. Expectations of negative 7.4% are due to the oil, gas, and consumable fuels industry, which is anticipated to fall 9.4% from the year-ago quarter. Share buybacks, accounting measures that exclude special charges, and cost-cutting are still playing a role in continued earnings growth rates. One metric companies can't manipulate, however, is revenues, up to 4.3%. It's the highest estimate since the second quarter of 2012. This is by and large attributable to the consumer discretionary sector. While these numbers still remain much lower than the 10-year average of 7%, 8 of the 10 S&P 500 sectors are expecting positive revenue growth in the third quarter. Earnings season will continue next week with 76 companies scheduled to report. I'm Christine Short, and thank you for tuning in to this week's edition of the Lookout Report.